Recently, I wrote my English essay on the stock market crash of 1987, also known as Black Monday. I went into thinking it was just another historical event, but the more I researched it, the more I realized something uncomfortable. That crash didn't happen just because of numbers or charts. It happened because of people. Fear spread, panic spread, everyone followed everyone else, and that's what inspired this video. Because the same behavior that caused the crash in 1987 is still happening today, just with faster internet, social media, and louder opinions. So today, we're talking about mob mentality in the stock market, what it is, why it's dangerous, and most importantly, how to avoid it. Mob mentality is when people stop thinking independently and start copying the actions of a group. In the stock market, it looks like this. Everyone is buying, so you buy. Everyone is panicking, so you sell. Everyone online says something is the next big thing, so you jump in. And the scariest part? Most people don't even realize they're doing it. During the 1987 crash, investors saw prices falling and assumed everyone else knew something they didn't. So they sold, which caused prices to fall even more, which caused more people to sell. It became a feedback loop driven by fear. And even though technology has changed, human psychology hasn't. Mob mentality is dangerous because it makes you react emotionally instead of logically. When you follow the crowd, you buy too late when prices are already inflated. You sell too early when fear is at its highest. The crowd usually shows up at the worst possible times. That's why the saying exists. The market transfers money from the impatient to the patient. Mob mentality removes patience. It replaces strategy with urgency, and urgency is expensive. In 1987, news traveled slowly. Today, it travels in seconds. Now, mob mentality looks like trending stock tickers, viral financial influencers, comment sections screaming, buy now or get out. The problem isn't information. It's too much emotion packaged as advice. When you constantly see people bragging about gains or panicking about losses, your brain starts to feel like you're falling behind, even when you're not. Social media doesn't reward patience, it rewards reaction, and the stock market punishes that. Here are some red flags to watch for. If you're buying a stock mainly because everyone's talking about it, I don't want to miss out, or it's going up too fast, that's mob mentality. If you're selling because the market is red for a few days, everyone online sounds scared, or you didn't have a plan to begin with, that's mob mentality too. The crowd doesn't ask why. The crowd just moves. Here's how to avoid mob mentality. Number 1, have a plan before you invest. If you don't have a plan, emotions will make one for you. Before buying anything, know why you're buying, how long you actually plan to hold, and what would actually make you sell. If you decide those things in advance, panic has less power over you. Number 2, focus on long-term value, not short-term noise. Most market panic happens over days or weeks. Wealth is built over years. Zoom out. Ask yourself if the company or investment will matter in 5 or 10 years, not 5 or 10 minutes. The market is loud in the short term and logical in the long term. Number 3, limit who you take advice from. Not everyone giving financial advice has your best interest in mind. Some people are chasing views or flexing gains without showing losses. Learn from the people who talk about risks, mistakes, and process, not hype. Calm voices beat loud ones. Remember, fear and greed comes in cycles. The same emotions that caused the 1987 crash show up in every crash, every bubble. Greed says, this time's different. Fear says, this time it's over. Both are usually wrong. If you can stay calm while others panic, or stay patient while others chase, you already have an advantage. Writing that essay on the 1987 stock market crash made one thing really clear to me. Markets don't crash because people are bad at math. They crash because people are bad at emotional control. If you want to be a better investor, don't try and predict the market. Try to control yourself. Think independently, have a plan. Ignore the noise. Because in the stock market, the crowd isn't your safety net. It's usually the warning sign. That's all for today. If you liked this video, make sure to like and hit subscribe. Thanks for listening.